Hello everybody, this is professional real estate investor David Campbell, and welcome to today's webinar, the Ultimate Tax Smackdown event. We've got Solo K doing a flying spinning kick up there, and Self-Directed IRA just really waiting to see who wins this fantastic Smackdown event. And it's kind of a funny concept, but really, you know, when you're looking at your finances, if we can find a way to make them fun, if we can find a way to make it visually engaging, you will learn more. So thanks so much for taking the time to be with us today. We have some pretty fantastic faculty and some great concepts for you. Let's just start with the end in mind, why we have this particular webinar. Three great companies and three great faculty members today. Myself, David Campbell from Hassle-Free Cash Flow Investing, and we have Kaaren Hall from UDFI IRA Services and Amanda Hahn from Keystone CPA. And what this webinar is about is introducing new people to new relationships. You know, we each need to have relationships with different providers, different vendors, different investors, so that we can put our team together to be more successful. So this is really about just getting into new relationships, us getting into relationships with you, and you getting into relationships with us. We'd love to share some great ideas for you, give you some opportunities that you can implement into your investment strategy. And very clearly, you know, I'm always, when I go to a free webinar especially, I always say there's no such thing as a free lunch. Like, when's the shoe going to drop? When's the $1,000 boot camp going to come out, or the free, you know, thing turns into something really expensive? And really the entire sales pitch is each of our companies are very skilled at doing what we do best, and if you have an interest in working with us, there's a slide at the very end on how to get a hold of us. So that's it. That's the whole sales pitch in a nutshell. This is really as much pure education as we can give to you, but we want to stress that this event is not investment, legal, or tax advice. Each of us do provide our own world of expertise, but you, by attending this webinar, have not engaged us specifically for our expertise, and so this should really just be taken as an educational format, and if you want specific advice, engage the appropriate licensed advisor for that advice. I started out as a high school band director and became a professional real estate investor over a series of small steps over about 12 years. I currently own a production home building company in Dallas-Fort Worth, Texas, and a commercial real estate syndication company where we put groups of investors together to go buy shopping centers and medical buildings. And what I mostly do is educate people like all of you just on how to be a generalist, how to put your team of people together. And on my team are two fantastic faculty today. We're going to get a chance to meet Kaaren Hall from UDFI IRA Services, and she is my #1 go-to person for my own IRA needs as well as for the IRA needs of my clients. So let's say hello to Kaaren Hall.
Hey David, how are you?
Doing fantastic. And just finishing tax season, and amazing that she is able to join us. You're really good. Day after tax season is done. My personal tax advisor for myself and for many of our clients as well, Amanda Hahn from Keystone CPA.
Hi David, hi Kaaren. Thank you so much for having me. I'm really excited to talking about our Smackdown today.
That's right. Let's see who's going to win. And what's great about putting a team together is, as a generalist and putting my investment strategy together, sometimes I get a question and I can call up Kaaren and I can call up Amanda. And the way that this webinar came about is I had a very specific question that was a tax-related question, and I didn't know the answer, and I started talking with Amanda, and I thought, wait, don't give me all the answer now, because if I have this question, I'm sure that a lot of my clients have the same question. Why don't we turn this into an educational webinar so that everybody gets the advantage of having this this conversation? And then we talked to Kaaren because her expertise is critical to this particular tax strategy that we're putting together. And so here we are today on this webinar. So when you're looking at what your job is as an investor, your job is not to know everything. You know, if you're on the call and your goal is to learn everything about self-directed IRA and everything about how to do your own income taxes, you're really going to set yourself up for either having a very small world or not being very successful as an investor, because each world of investing is so complex. You need to have a specialist help you navigate those waters. And so the goal of today's webinar and the goal of really all of your education as an investor is really to learn how to ask good questions and then how to speak intelligently with the specialists on your team, so that if you've got a tax question or a financing question or a brokerage question, management question, whatever it is, you know how enough to know who is a good team member for you, and when you talk to that team member, how you put it together. Now, I actually have a solo K because that makes sense for my business, but I didn't really understand the difference between a solo K and an IRA. I really thought they were the same thing until I started talking with Amanda and realizing that the reason I had a solo K was very specific to my investment objectives as a real estate investor, you know. And so let's just do another quick poll here to see how many of you out there actually are currently working with the self-directed IRA. Not a 401k, not a solo K, but it's specifically a self-directed IRA. And it looks like only about a third of you actually have a self-directed IRA. And let's ask the same question about solo K. This is from a popularity standpoint. You know, most of the people that I talk to don't actually have a solo K. They actually have a self-directed IRA. But let's see if there's anyone out there that currently has a solo K. And that's exactly what I expected. It looks like 95% of you do not. So those of you who are working in the self-directed world are primarily in the IRA, and that the solo K is a new concept. So that's a good thing for you to, attending today's webinar. We're going to really show you potentially the benefits of why a solo K. So this is just a moment of political commentary for myself. The tax code is insanely complicated. It is thousands and thousands and thousands of pages. I don't know anyone who has ever read the entire tax code. Amanda, you're the smartest tax person I know. Do you know anyone that's actually read the entire IRS code?
No, I don't know. I don't know anyone who has, and I don't know anyone who can claim to be an expert in all aspects of taxation either.
Yeah. The code is so complicated that even if you are the world expert specialist in the tax code, you've only scratched the surface of how complicated the tax code is. And so when you do talk to your CPA and say, well, what's the best strategy for me? Or, hey, I'm thinking about using a particular vehicle like the solo K. Do you think that's a good idea? The answer is always compared to what and what's your specific situation. And so when we're talking about a particular tax vehicle, like the solo K Smackdown, which is better? Well, the answer is there isn't better. It's only what's appropriate for you. And so if you're looking at the answer of which is better, solo K or IRA, I think my opinion is what's your situation and what's appropriate to you. The reason the tax code is so complicated, it's complicated on purpose. It's not designed to be simple. It'll never get simple. If you hear politicians saying we're going to simplify the tax code, that's just silly. That's not going to happen. The tax code's designed to stimulate certain economic activities that favor the rich. One of those economic activities is providing clean, safe, affordable housing and clean, safe, affordable places for businesses to run their business and to have businesses. So the tax code is there to encourage people to own real estate, encourage people to own businesses. And it's really designed to penalize those people that don't have businesses and don't own real estate. Amanda, is that a fair summary?
Yep, that's exactly right.
The other reason the tax code is so complicated, I learned from my own emotions. I got a letter, recently that says, "Dear Mr. Campbell, we are auditing you for the tax year 5 years ago. Sincerely, the IRS." And my first response is fear. Like, oh my gosh, 5 years ago, I hardly remember what I was doing, let alone what my taxes were. And creating that fear of the IRS, I think tax audit and public speaking and heights and those are some of the things most feared by people. So a lot of poor people or people with poor financial education, they don't really branch out into economic activities because they're afraid of poking their head into the sand and getting audited by the IRS or doing something wrong in the tax code. And what that does is if you can afford to have tax counsel, if you can afford to hire a specialist like Keystone to be on your team, you have an unfair advantage against all of the people in the economy that can't afford to hire good tax counsel. And so if you're a rich person and you control the tax code, of course, you're going to make the laws as complicated as you can because it favors you, and it creates a barrier to entry so that poor people and middle-class people can't really break into the wealth that we all have the opportunity to access because we can't access good tax counsel. So I applaud all of you for coming on the call today, really making an effort to improve your financial situation, and part of that is through good financial education. So beginning with the compelling why, like why, David, should we be talking about IRAs? And really the answer is about compound interest. And if you start today with $1,000 and you invested at 12% and you had to pay taxes every year on that money, which is what most people do, your $1,000 after 30 years is $11,000. Pretty good. Yeah, most people would jump for joy. That's awesome. But if you could make those same returns, exact same investment, you didn't increase your risk. Most people think they have to increase risk to increase their returns, and that isn't necessarily true, because if you're investing inside an IRA versus outside the IRA, it's potentially the same investment, but the investments inside the IRA grow tax deferred, and over a period of 30 years, 300% difference in the return, or the amount of capital that's available to you, just by learning how to avoid or defer the payment of taxes. Amanda, do you want to talk about that in any way?
Yeah, and I think you were talking earlier about the barrier to entry and creating wealth, and so I think your slide here, it's a really great example of how quickly you can generate wealth and build up your net worth when you take taxes out of the equation. So if 100% of our funds are working for us and generating a return, and we don't have to pay Uncle Sam first, then our money is going to grow much, much faster, just in such an accelerated manner. And that's why it's really important to be talking about all of the various tax-efficient and tax-free ways to invest our money.
Yeah, there's two political candidates running for president right now, and the media was talking about their tax return, and one particular political candidate was criticized because they were only paying about 12% of their income in income tax, and the other political candidate was paying somewhere around 27% of their income in income tax. And the media was saying, well, it's not fair that this political candidate doesn't pay their fair share of taxes. And my thought was, the guy who's paying 28%, I don't want him to be my president because he's not smart enough to figure out the tax code to pay the least amount of taxes that he's legally obligated to pay. And the guy who's paying, much less in taxes, I thought, this guy's really smart. I mean, let's give the guy a lot of credit for being a good businessman. I want a good businessman running my country, not someone who can't figure out the tax code and how to pay less.
Yeah, and that's a really great point because, I mean, being a tax advisor, we definitely see that a lot of the times when clients who have more money to invest, more wealth, typically are at lower rates. than the other clients who, are working very hard, working 9 to 5 and generating W-2 income and all sorts of active earned income. And so, yes, I mean, the equation to building really, truly low tax lifestyle or, zero tax lifestyle, a lot of times it's not going to happen in the next year, but it is an overall goal to try to start to shift money that you're generating from the higher tax brackets to the lower tax brackets. And retirement investing and retirement-related strategies are one of the most powerful tools that we all have to utilize to bring us to that goal.
I want to say that when I was a school teacher, I paid more in taxes in a percentage and as a gross number. I paid more in taxes as a school teacher than I did as a business owner owning millions and millions of dollars worth of real estate. And I thought, I can see why school teachers would say, that's not fair. I'm paying more in taxes than someone who is making a lot more money than me. And you could take the fact that, hey, that's not fair, or you could say the tax code is created so that everyone can take advantage of it. So if you want to be the guy paying less, do the economic activities that allow you to pay less in taxes.
I think there's a lot. I do talk to a lot of people who are working and participate in a 401k plan. I think that's the most common type of retirement plan that everybody knows about. So if you're working for GE or Toyota, that you might be eligible or you might be participating in a 401k plan. And so it's really important to know that there are options. If you're someone who's interested in taking control of your retirement account, you don't want to be limited to the stocks, bonds, and mutual funds, and you want to self-direct that into real estate or other businesses or any other type of investments that you know more about. There are options for you to do rollovers or transfers, and also not only to contribute the maximum to a 401k or a solo 401k account, but also have the ability to control those funds as well.
A lot of people look at owning real estate in their IRA and they say, well, why would I want to do that? Because my financing LTV is lower, my interest rates are higher because I have to get non-recourse debt, and I've got UBIT problems. And ultimately, when you become financially independent and you can have a lot more tax advantages available to you as a business owner, not as a W-2 employee, I see the huge advantages of not investing in real estate through your IRA, but owning it outside your IRA. But while you're working as an employee, many times that's the only pool of funds that someone has available to them is the wealth that they created through their IRA. The only tax breaks they get is because of their contributions to their IRA. Amanda and Kaaren, could you just very simply talk about what is an IRA, what's a qualified plan, and why would someone want a qualified plan?
Sure. A Selfdealing is a retirement savings account, a tax-deferred retirement savings account. And an IRA is the very same thing, a tax-deferred retirement savings account. So in that sense, they're the same. The difference between the two of them is that in order to have a solo K, you need to be a business owner. Well, I think that you elaborated on it so well when you described tax-free savings versus tax savings. The compound interest is so much greater, but when you can invest and have those, have the money come out in that way, you just make so much more. But also, we all have to save for retirement, so using the qualified plan is, like you said, a great vehicle, sometimes a forced savings vehicle if you're using it as a 401k at work. Just a great way to save money and save on taxes.
So are there any kinds of investments that you think work better in a qualified plan versus just owning outside of your qualified plan?
Of course, when you buy real estate outside of the IRA, you get so many advantages. You get to write off all the things that I know Amanda's, she probably has writer's cramp from from just finishing tax season and helping people take all those write-offs.
I think one way to look at it is something that, David, you touched on a little bit earlier, which is, where is your money, right? If right now we feel that the real estate market in Southern California, for example, if we feel that this is a great market area and we really want to invest, we really want to get into the game and build some passive residual cash flow, but maybe we don't have money in the bank. And if that's the case, then would it make sense for us to use our retirement money to invest in this particular deal or in this particular property? Sure, right? Because I mean, sometimes people say, well, you can't take a deduction when you invest with your retirement account, but you also got to take a look at the first and foremost important thing is, what is the return on investment? And if it means for me to tap into my retirement money to be able to get into a really great property to get some passive cash flow for the next 5, 10, 15, 30 years, then yes, a lot of times it does make sense. And like what you were saying earlier, a lot of our clients who are W-2s, who are full-time employees, let's face it, they're not really going to get the benefits of investing in real estate outside of their retirement account anyway. So from that perspective, it definitely could make a lot of sense to use retirement funds and to generate tax-deferred or tax-free cash flow from their investment activities.
I tend to think if you can buy real estate outside of your IRA, it's better because real estate's already a tax-deferred asset and a tax-favored asset. So having a tax-favored asset inside of your IRA, the math starts to be, if I can have one or the other, I'd rather have it outside. But the vast majority of my clients don't have money outside their IRA. The only money they have to invest is in their IRA. And then when you look at what investment choices do I make inside my IRA, do I buy real estate or do I buy stocks? Well, I'm a real estate guy, so I definitely, say own real estate in your IRA versus any other potential, paper assets, et cetera. But one of the challenges of real estate in your IRA is UDFI. And could our esteemed group of specialists talk about what's UDFI, how is that problematic in an IRA, and how can we avoid it?
Regarding UDFI, it is, of course, unrelated debt financed income tax. That's what it is. And so basically the way that's applied is, say, for example, you have an IRA that takes out a non-recourse loan, because that's really the only kind of loan that can be made to an IRA. And then the proceeds that are received into the IRA that can be attributed to that leverage. So in other words, if you have 50% loan, 50% IRA, then 50% of the proceeds that come back in would be subject to that tax. So that's a real quick overview from my perspective of what UDFI is. And when someone asks me, I always refer them to the IRS website. It's irs.gov, and then it's publication 598 that goes into some detail. So to address that point, but of course, it is tax code, so I'd love to hear what Amanda has to say.
I was waiting for you. Okay, well, I guess it's really important. I mean, first of all, for any of us or anyone on this call today who, if you're a real estate investor, we all know what do real estate investors love? Leverage, right? We want to be able to use other people's money. And so what's really interesting as an opportunity is that you are able to leverage even your retirement money, whether that's IRA or solo K. So from the smackdown perspective, you can use either one of them for leverage. Now the UDFI, Kaaren did a really great job of explaining, how it's calculated, but basically, why does that exist? Well, it's because the IRS, every year they tell us this is how much you can contribute based on your income, based on your age, based on your work history, job description, all that kind of stuff. And so because you're limited on what you can contribute, what the IRS is trying to do is they're saying, hey guys, I want you to save towards retirement. I want to give you a benefit so you can have tax-deferred investing, but I want to still control how much tax-deferred money you have. I don't want the entire U.S. population to have all of their money in the retirement account, thus no one's paying taxes. Now, because of this core rule that they have, they're still allowing us to leverage our retirement money, which means if I have $50,000 in my retirement account, I could borrow money so that I can buy a bigger property or make a bigger investment. Now, because you're allowed to do that, you're getting some sort of unfair advantage, right? Because you're essentially bypassing this annual contribution rule, and you're able to use other people's money to help your retirement money grow a larger amount of tax-deferred or tax-free money. And that's really the concept behind why there's this UDFI tax. The way it's calculated, like what Kaaren said, it's actually on net taxable income, What does that mean for most real estate investors? For the most part, it's going to be a moot point, because when we look at net taxable income, we're looking at your ability to still write off all of the other deductions that you otherwise would outside of your retirement account. So you have income, you've got some, let's say if it's a rental property, you have rental income, rental expenses, property management fees, you have depreciation, and all of the other, regular expenses. If at the end of the day you're coming up with a close to zero or even an overall loss, then a lot of times this UDFI tax is not even going to be an important thing to consider, because it's based on net taxable income. Just finished talking about the UDFI tax, and like I said, it was a 35% on whatever the net taxable income is going to be in the investment that your retirement money is invested in. So if you look at the slide that David has up here, you can clearly see in the column that is named Solo K, there's no UDFI taxes. So when we go and talk about the smackdown, this is one of those points or areas where the Solo K is a lot better than the traditional IRA or the Roth IRA or any other type of IRA, essentially. The Solo K, in the self-directed arena, it's one of those very few retirement vehicles where you can use your money, you can leverage or invest in leveraged real estate and not have to worry about the 35% in UDFI taxes. So that's one point for the Solo K.
Yeah, the Solo K is such a great tool. I love it, and the fact that you can avoid UDFI is just one of so many different benefits to it, and a lot of them are outlined here. And I think, David, this is what you're going. This is a point you want to make with the whole webinar about what's so great about the Solo K versus all these others. And so I think this slide here is a summation of all that. But one of the great things, just starting us off at the top, is how much you can contribute to it. $50,000 a year versus 5, perhaps, if you're under 50. That's 10 times more, so it's 10 times better in this case. There are all kinds of, things to consider here. For example, your age, and I think we should also, when we talk about the Solo K, really start at the beginning, which is to say, how do you even qualify for a Solo K? If you qualify for a Solo K, if you're self-employed and you have no W-2 employees in any of the companies that you work for, then you qualify for this kind of plan. So if that's you, here's the Solo K giving you an opportunity to have 10 times more tax-deferred savings than the other accounts. So I think that is one of the top wonderful things about this particular plan.
Yeah, and actually I know we have here the Solo K maximum contribution for 2012 is $50,000, and for individuals who are over 50 years old, by the end of the year you actually get a catch-up contribution. So the total that one individual can put into a Solo K retirement account is actually $55,500 for 2012.
That's a great point, because here on the slide too, under the tax-free for life contributions, one of the things about the Solo K is that it's got a Roth bucket. You can choose to have a Roth bucket, which means that you can put money into the Solo K after tax. It's taxable money when you contribute, but the proceeds grow tax-free for life. And you can put $17,000 a year into a Roth bucket, also a catch-up contribution on that as well. And that is, if you're 50 or over, you can contribute $22,000 to the Roth bucket. So that's just yet another advantage. There are times, say for example, if your income exceeds a certain amount, and I know Amanda knows all those tables, but if your income exceeds a certain amount, you can't even contribute to a regular Roth. But if you qualify for the Solo K, hey, you can contribute between $17,000 and $22,000. It's so powerful.
Yeah, I love, whenever we have an opportunity to contribute to a Roth bucket, either Roth 401k or a Roth IRA, I really always try to encourage clients to do so, because, what's better than tax-deferred money? Well, it's tax-free money, right? Money that you never, ever have to pay income taxes on for the rest of your life, or over the lifetime of your beneficiaries. And what Kaaren said was exactly true, that Yes, we'd all love to be able to contribute to a Roth IRA, but of course the IRS has income limitations. So for anyone in 2012, I actually just looked up the numbers because, believe it or not, I don't have all of these memorized in my head. But for 2012, the income limitation increased, so that's good for a lot of us. If for married filing joint, if your income is below $183,000, then you can contribute to a Roth IRA. But if your combined income is above $183,000, you cannot make Roth IRA contributions. And so the benefit of having a solo K, again, like what Kaaren said, is there is no income limitation. So you could be making $1 million or $10 million or $1 billion and still be able to contribute to the Roth bucket of your solo 401K and get that tax-free money in there permanently.
And if you want to talk about, David, if it's okay to move on and talk about the other attributes, I'd love to do that. Is that the plan here?
Yeah, that sounds good.
Okay, well when it talks about a plan loan, that's something that I get a lot when people are calling me and asking about self-directed IRAs. They're saying, okay, and can I borrow from that? And the IRS in Publication 590 is really specific that you can't borrow money from your IRA. And I will say that a lot in the webinars that I do. You know, no borrowing from your IRA. But guess what? The Solo K is really, like you said, smackdown event because you can borrow from the Solo K. You can take out a plan loan of $50,000 or 50% of the account value and use that money for anything you want. Now you have to pay yourself back at least quarterly at a reasonable rate. And if you know what rate is that, I would be asking Amanda about that. But you have to pay but you're paying back your own IRA, so the interest is going to you. And it's money that you can take out and maybe pay for a child's college education. It's money you could take out and use for maybe you needed to acquire a new vehicle or something like that. But it's just such a great tool. There are a couple more things to say about it. I know Amanda's going to have things to add, but one of the things I think is really important is if you do take a plan loan, remember that if you set up a self-directed IRA or any IRA, any solo K, and then you immediately take out a plan loan or do it at some point, and then you never make a contribution, the IRS could come back to you and say, hey, wait a minute, you only opened this solo K because you wanted to take a plan loan. You didn't open it to save for retirement because you never made a contribution. And so we're going to say that you've had personal benefit from your solo K, and we're going to say you've committed a prohibited transaction. And that's bad because when you could commit a prohibited transaction, what they typically do is disperse your entire retirement account to you as a taxable event. So just make a contribution and avoid that. So if you're going to take a plan loan, wonderful. Just make sure that you're making contributions from time to time so that you are proving that you're using this vehicle for investment purposes and not just for personal gain.
So this is so amazing. I can put $50,000 into my solo K, and then I get a tax deduction for making that contribution. Are we on the same page?
Well, I would say $100,000 because you can take out 50% or $50,000. But say you put $100,000 in, yeah, you get the tax advantage, and Amanda can certainly attest to that.
So I make a $50,000 contribution, and then I borrow about $25,000, so I get a tax write-off. Let's say I'm in the 30% bracket, and I put in $50,000. I avoided or deferred $15,000 of taxes, and then I pull $25,000 back out. Really, who wouldn't do that?
Because typically, I think if you talk to anyone and say, hey, would you rather pay towards IRS or pay your retirement account, everyone's going to say, well, yeah, I want to pay towards my retirement account. But my question, though, is, well, if I fund all my money in the retirement account, what happens if I need to use it? What if I have an emergency? Or what if I just, I do want to keep the cash flow? And so the solo K, that's one of the reasons this is such a great tool, because it gives you that flexibility to fund, if you funded $100,000, you get a $100,000 write-off, and you can turn around the very next day and borrow up to $50,000 or, half of whatever the total account balance is. So essentially just really, moving money from your left pocket into your right pocket and getting a deduction for doing so.
I think that the solo K is looking pretty good in our SmackDown challenge. What do you think?
That's 3 points right now. We talked about higher contribution limits. We talked about how it avoids the 35% UDFI taxes if we wanted to leverage our retirement money to invest in leveraged real estate. And then the third one was our ability to basically borrow from our 401k account and access that money tax-free, penalty-free. 3 points?
I think that's pretty good. What about retirement age? I'm looking at that last line and really wishing I could retire 5 years early. How do we do that?
Yeah, you definitely can. It's a lower retirement age, and so I mean, what could be? You know, you don't have to wait. You're right. You don't have to wait 5 years. You can retire early, and begin to take money out of your plan without any kind of penalty. I mean, if it's pre-tax money you put in there, of course you're still going to pay the tax, but the Roth money can come out at that point tax-free, and at 55. I mean, why wait? Why not enjoy your retirement now?
So we took the poll, and about 1/3 of our audience had a self-directed IRA, and only 5% had a solo K. And all those people with a self-directed IRA are probably scratching their head right now saying, why didn't someone tell me about solo K because it's so much better? Well, all that glitters is not gold. Let's try to find a point in favor of self-directed IRA versus solo K.
So solo K is just another type of retirement account. And, you know, I think if you like hearing about some of the benefits, the ability to contribute, the Roth, the borrowing, all that stuff is something that you're interested in, that you like, you know, definitely speak to your tax advisor, or you can, you know, speak to one of us, because everyone's situation is different and unique. So, and if you are someone who can contribute to a solo K, it definitely would be worthwhile to have the conversation and see how that could benefit you. David, I think the poll really reflects kind of what my experience has been in talking to people in terms of, you know, people who actually even know a solo K exists. And I think, you know, a lot of times when you listen to speakers or you're reading stuff, you know, there's a lot of publicity and educational content out there, and it's been for several years about self-directed IRA. And so I think that's why a lot of, you know, I think everyone knows about an IRA, $5,000 or $6,000 per year. And so it's important to know that a lot of times when you hear people talk about self-directed IRA, a lot of the concepts and strategies also apply to self-directed solo K. Maybe it's just not as smooth to say self-directed solo K, as it is to say self-directed IRA. I think that's one of the main reasons that there's not a lot of, you know, as much public awareness. But also, not everybody is eligible to contribute to a solo 401k. And a solo 401k is just like what it sounds like. It's for a solo practitioner or solo business owner. So in order to qualify to set up a solo 401k, there's a couple things that must be in place. One, you must have your own business. And by business, I don't mean you have to have an LLC or a partnership, okay? I mean, it's great if you have a legal entity for your business. That's perfectly fine. But what a lot of people don't know is that as sole proprietors, okay, if you're a Schedule C sole proprietorship, you also may be eligible to have a solo 401k. The requirement is that in order for you, if you wanted to be eligible for solo K, you can't have any other employees in your business aside from you and or your spouse. So the point in time when you start to have employees in your business, then you can still have a 401k. It's just no longer called a solo K. It would just become a regular 401k, which is what most people are familiar with, you know, if you're working for a large company. But that's one of the main things, is that a lot of people don't know they have the opportunity because maybe they're operating as a sole proprietor or a Schedule C. So there's no legal entities that have to exist. You just have to have a business, an active business, in order to qualify for the solo K.
And of course, if you have a business, you have no full-time employees, then you qualify. But if you have part-time employees, you're allowed to have part-time employees who, I believe, work up to 1,000 hours a year, something like that. So if you have some part-time employees, you can still get a solo K. Isn't that correct?
Yep, that is correct.
And what about 1099 employees?
1099s are not considered employees. They're considered contractors. So that does not prohibit you from having a solo case. So, you can have a, let's say you're operating your business as an S corporation. We have a lot of clients who are S corps, and they have, 10, 15, 20 1099 contractors who are maybe doing their sales or, doing like data entry or, people who are overseas. All of those are okay. So 1099s are not prohibitive in terms of who can open and fund a solo case.
I have several clients that are doctors, and they might own their medical practice, and they have 10 or 15 employees in their medical practice, but then Medical Practice LLC is managed by Dr. Smith Inc., and Dr. Smith Inc. receives a management fee for managing the medical practice. And then inside their corporation, which is the management corporation, there's no employees except for husband and wife, and then they take their retirement benefits at the management company level rather than the company level that has employees. Tell me about that, if that's a viable strategy or not.
And I hate to give popular answer, so unfortunately I have to give the unpopular answer. Although I love your idea, David, there's a rule, and it's called attribution rules, which means that if, in your example, if this particular doctor, if he controls the medical practice with the employees as well as this other management company that he has with his wife, then he is so prohibited from having a solo K. Because when the IRS looks at who's eligible, they're looking at not just the specific entity or business where you set up the retirement account, they're looking at all of the other businesses that you own and control. And if there are employees in those entities, then those employees must also be eligible for whatever type of retirement account it is that you're offering. And the rule basically exists so that people wouldn't just go off and set off little companies here and there so that they can fund the maximum for themselves and not have to pay any retirement, matching contributions or anything like that for their employees. Now, having said that, so that's the general rule that they look at it in the aggregate. What are all the companies that you own and control, and do we have to attribute all of those into this other company here that you're trying to set up the retirement plan? And if you own 100% of all of them, then no, this is not going to fly. On the strategy side, then, it's looking at, well, can we somehow change the ownership a little bit? I have a client, he works very closely with his brother. And, Kaaren, you already know this, the siblings, a lot of times when we look at self-directed and prohibited transactions, they're not considered part of the linear, how do you say linear descendants?
Oh, ascendants and descendants, you bet.
Yeah. I'm doing your hand movement as I'm talking here.
The genuflect, yeah.
Yes, and so one of the things we worked with him on is, well, let's change the ownership a little bit. For his spin-off management company, in this example, he had his brother come in, he had his mom come in, and they now own more of the controlling ownership. He wasn't able to set up a solo K in this particular example, but he was able to set up another type of a retirement plan where it allowed him to contribute a lot into it without having to, contribute tons and tons of money for all of his other employees. So there are different situations where it could work, but generally speaking, no, if you're controlling 100% of all these little entities here and there, they have to be looked at in the aggregate.
Most people on this call, I think, are probably high-income earners making a W-2, wishing they could have some type of a business so they qualify for a solo K. What's the strategy that you would give to a high-income earner that wants to own real estate and wants to have a solo K, but they don't have a business?
It really is to start a business, because once you start a business, you can start to shift so many of those personal expenses into legitimate business deductions. One of the things very similar to what you just talked about, David, is buying properties. Okay, the properties themselves are not going to be considered an active business for purposes of having a retirement account, but they can have a property management company, right? The property management company that manages all their other investment properties. The income generated in the management company could allow them to open and contribute to their very own solo K. We've seen that. We've seen clients do that time and time again, and that definitely works. The one thing also I want to touch on is you said, a lot of our listeners today may be people who are highly compensated employees, which means most likely they're covered by an employer plan at their work, right, with a full-blown 401k. It's important to note that even though you're covered with an employer plan, that does not prohibit you from having your own solo K. Okay, so your company, if you're working for GE and you have a 401k plan with them, you can also have your own solo K in your property management company. That's definitely valid, and you can make contributions to both 401k plans as well in the same year. But there are limitations in terms of, how much can you contribute to each plan.
Yeah. So the strategy potentially is if I am an employee and I go out and I buy a couple rental properties, and then as a sole proprietor, I manage my manager that manages those properties. So I'm not actually collecting the rent, but I, handle the asset management and I coordinate with the property manager, et cetera. Can I take an income as a sole proprietor for those management duties, so Schedule C or something like that, and then use that sole proprietor income to fund my solo K? Is that the strategy?
Yep, that's exactly right.
Mm-hmm.
Well, and then as a self-directed IRA provider, I have to throw in there that there's no self-dealing when it comes to being self-directed. So the solo K that's not self-directed, that's one thing. But if you're going to, anyway, just to make sure that whenever you've got a self-directed IRA that you are not doing any of the work, there's no self-dealing, no present benefit. Keep everything arm's length. So there's that.
Yeah, that's so the tax code is so complex. Every time we find one strategy, we find an offsetting thing to be mindful of.
Mm-hmm. That's why we call them self-directed IRAs, because it's the easiest thing to say, and then we can get into the details after that.
Yeah.
Yeah, and I think in your example, it does make sense. I mean, for someone who's earning a higher income, it probably does make sense to start investing in real estate with funds outside of your retirement account, right? I mean, if that's where the money is, start there. Then you can have your management company, and then you can start to have a self-directed solo K. You can start to fund and set money aside to then use that into investment property. So I think that's a really good point that Kaaren brought up, is that now when you go, once you have money in your self-directed account and you use that to buy real estate, you just have to make sure that's a different set of real estate, and you can't use that money to buy any properties that you already own.
Many people are wishing that we had done this webinar last week, but the question is, when do you need to open your plan?
Well, I mean, so yes, I know people probably wish this was done last week, but if it makes anyone feel any better, you actually could not have contributed to a solo K for the 2011 year unless you've already had this plan opened by the end of 2011. So to answer your question, what you want to do now is, if you think you're eligible for a solo K, definitely check with your team of advisors, make sure that you confirm eligibility, figure out how much approximately you think you can fund. What you have to do is you have to make sure the solo K account is opened by December 31st, 2012. You don't have to make any contributions, but you do have to make sure that the account is open by year end in order for you to be eligible to contribute for this year.
So they open the plan at UDirect, let's say this month, and then they can make a contribution for 2012. What's the latest they can contribute to their 2012 solo K if they open their plan now?
That would be April 15th of next year, right, Amanda?
Well, yes and no. They never make anything easy in the tax world. So I know it's such a simple question. I'm going to give a somewhat long answer. So the solo K, because it's an employer plan, there's two different people that's contributing to your 401k. One is you as the employee, and the other is your business as the employer. Okay? So the employee contributions, that has to be done by December 31st, 2012. Okay? The employer portion, whatever your company is matching you in your solo K, that could be done all the way up until the extended deadline of filing your tax return or your entity's tax return. So depending on if you're a Schedule C sole proprietor, you could have all the way up until October 2013 to still make a contribution for 2012. If you're an entity, an S Corp or something like that, then you'll have until September 2013 to make a 2012 contribution. Isn't that great?
That was so complicated. The most important thing I got out of that is, what's your phone number? Because I'm yeah, we'll have your phone number at the end of the presentation. But that's exactly what I mean by being a generalist and having specialists. Because as a generalist, I know enough to say I want to have this plan, but I have no idea how to put the logistics together for this. The most important thing I need to do is build a Rolodex of people that I know and trust, so that when I actually go to make this investment, I can call Kaaren and say, okay, is my plan open? Okay, great. Amanda, do I qualify? Am I sending the right amount of money? Am I doing it at the right time? And that's the, if you're at home and you're already overwhelmed, the most important thing is just to start writing down questions. If you go through this whole seminar and you have more answers than questions, then you aren't listening deep enough. You know, at the end of this, you're probably going to be more confused than when you started, and that's fine, because every question, you know, leads to two more questions, or every answer leads to two more questions. So speaking of questions, we've got a lot of audience questions, so we're going to start jumping into those. Jackie asks, the greatest challenge I face using my solo 1K to invest in real estate is finding a nationwide lender who takes non-recourse loans. Do you have any experience working with such a lender, and can you share the lender's contact and experience with us?
I can answer that one. I have a list of non-recourse lenders, and you know, there aren't a lot of them. But I do have a list of lenders who will lend on various kinds of real estate, in some only in certain states, and you know, they all have their own special terms. So if anyone would like that list, I'd be happy to send it to you. Just email me. My email is khall, Khall, at the letter U, udirectira.com.
If you go to a non-recourse lender, like North American Savings Bank is a lender that I've done a lot of work with.
Sure.
And their rates are somewhere in the high 6s, low 7% right now. Several points. You're going to pay a couple points at closing. And their loan-to-value is somewhere between 50 and maybe 65% loan-to-value. So you're paying a higher interest rate and a lot of points. However, when you are in a real estate syndication, the general partner, such as myself, I'll sign personal recourse on the note, which means we get low interest rates, which means we get high loan-to-value. But if you're solo K or self-directed IRA as a passive equity member in our investment, it's non-recourse to you. So that's what your IRA needs. Is it's not necessarily getting non-recourse financing, it's non-recourse to the retirement account, and that the person guaranteeing the loan is not a disqualified party. So as the general partner in a real estate syndication, I can give the benefit to our limited partners of lower interest rate financing and higher loan-to-value financing for IRA investors. Investing in a partnership is a potential way to get better financing for your IRA. Is that kind of the way that I was going with that?
Yeah.
Mark asks, when you say deferred, how much hit do you take at the end of the 30 years if you take the money out then? So you're investing, and then when Mark eventually retires, how much of a hit does he take when he takes the money out after the 30 years?
Well, the money that comes out of a tax-deferred retirement account, once it comes out, it's just considered ordinary income. It's distributions. So what tax rate you pay when you take the money out at distribution will really just depend on what's your tax rate at that time. So, you know, generally speaking, you know, most people, when you look at a long-term planning, you figure you're going to be at a lower tax rate when you reach retirement age, because you're no longer going to be working for your income. You're no longer going to have a W-2, or, you know, maybe for a lot of households that's dual income, 2 W-2s. So hopefully by that time you're going to be at a much lower tax bracket. Now, that doesn't mean we're saying you're going to be making less income. Hopefully, if you have the right team of advisors, it means you're making more income, but just a better type of income where, you're still able to keep your tax rates at a lower, taxes at a lower rate. So, when it comes out, it's just going to be based on whatever your personal income tax rate is going to be for the year that the money comes out.
A lot of people say to me, well, David, I don't want to plan on retiring poor. I want to plan on making more money when I retire than less. And one of the potential strategies is, let's say, Mark, right now, you don't have a lot of real estate on your personal balance sheet, but you're investing in your IRA for the next 30 years. That gives you 30 years to buy a bunch of real estate and build up a giant depreciation shelter such that when you start taking money out of your IRA, you've got an offsetting tax shelter to receive that income. Did I explain that well, Amanda?
Yep, that's exactly right. That's what we're talking about. We're not saying you have less income. We're saying you have more of the right type of income.
Kaaren, I can go to your company and set up a self-directed IRA and a solo K as well. Is that correct?
It is correct. That's exactly right.
Yeah, and is there any reason why someone who already has a self-directed IRA would want to do both?
I would think to maximize their retirement savings.
We just finished tax deadline last week, and so we're talking to clients about, well, are you wanting to maximize your tax savings? And if so, then you do have the opportunity to potentially fund both of these accounts, if not more. So some people are contributing to traditional IRAs, Roth IRAs, and solo 401ks.
So I can have a solo 401k, a self-directed IRA, and an HSA, and the three retirement accounts go buy a property together, equal parts, 1/3, 1/3, 1/3. Is that something that it would be allowed?
Yep, definitely.
Yeah. So it really, when you're looking at maximizing your deductibility in the current year, funding all of those fully makes a lot of sense. Even if you're getting different buckets of money, those buckets of money can come together as a partner and go buy property together. That's not a disqualified transaction.
Yep, and you forgot there's also the educational savings account that also could be self-directed, and I think Kaaren also can set that up too, right?
That's right, and you can also self-direct something called an HSA or a health savings account, which is really a great tool because when you put the money in, you get the tax break. The investments that you have in there grow tax-free or tax-deferred, actually tax-free. And then as long as you use the money in that HSA for a very long list of qualified medical expenses, it comes out tax-free. So here's money where you put it in, you get a tax break, and you never pay any tax on the gain for the rest of your life. It's better than a Roth. A Roth, you're going to pay tax on the money that you put in initially. This is even better than that. So in order to have an HSA plan, you have to first qualify for a special kind of health insurance coverage called a high deductible health plan. We abbreviate it and call it an HDHP. But if you qualify for that HDHP, you can get one of these health savings accounts, tax-free money. It's great stuff.
How does someone work with their advisors to really put this plan together? Because I can imagine people are at home taking notes thinking, oh, I want one of those and I want one of these and I want one of these, but do I qualify? And logistically, how do I actually know if I qualify? How do I set up my account? And then what do I invest it in? What are your best action plans on those 3 bullet points?
When it comes to that, that's the kind of thing that I would defer to you and Amanda, because when it comes to self-directed IRAs, we implement your strategy. So what you need to do is find someone like Keystone CPA, find someone like you, David, who's an advisor, and create a strategy, and then come to us and we can implement. So to answer that question about how to create the strategy, I'll defer to you two.
One of the things that I think I might have said earlier is a retirement plan is one of the many tools that we can all use to save taxes. And so, which one or more of these plans would be the best for you? That's the kind of stuff that, we'll need to determine based on looking at your tax returns, looking at your, getting an idea of what your goal is, how much do you want to contribute, what's your long-term goal, what type of investment are you looking to use, and from that, then we make our recommendation and the related strategies on, okay, these are the types of retirement plans that I think you should set up, and these are the amounts that you may want to consider contributing, and by doing so, these are the types of tax savings that you'll see. Part of that recommendation, just like what you said, Kaaren, is in us working with David, because we want to know, well, what type of assets are they investing in? And would that be best handled in a 401k, a solo K, or an IRA, or one of those things? So, definitely is a team of advisor approach, because it's not just about the tax. It's not just about opening an account, and it's not just about the real estate. And it's when you put all the different advisors together, that's the most impactful way to make sure that that we're building out the right overall strategy for you.
You said it perfectly. We've got a great question from Susie, and Amanda, I just copied you on this. Susie asks, I have a 401k from when I worked full-time at a corporation. I now work part-time and do not put anything towards this plan. My husband and I own rental properties, and he is the sole proprietor to his business, and he also works full-time outside the home. What would be the best plan for our situation? What can I do with my existing 401k? So let me just recap that into what I hear is Susie has a 401k from a former employer. Now she's working with a new employer. What does she do with her old 401k?
Well, that's a great question, and I'm sure Kaaren might want to jump in too. So, the 401k money that you have with your previous employer, that's what I typically call orphan 401k, meaning you no longer have to contribute to that. You now have control over those funds. What you can do is you can simply roll that money over into a self-directed account and utilize that to invest probably in real estate, because it sounds like that's what your specialty already is. So use that to invest in real estate activities. Now the question might be, when you roll the money out over into Karen's, should you set up a solo K or should you set up just a regular IRA? Well, you could set up a solo K if you have a side business. I know, Susie said that your husband is working full time and you now have a new employer. The real question is, do you guys also have a business on the side, or do you have a property management company that's generating income? If so, then you might be eligible to roll that directly into a solo 401k of your own.
So, Amanda, let's switch the scenario around. Let's pretend that Susie did not have an orphan 401k. Let's say she was working full-time at the company. She didn't change employers. She just went from full-time to part-time, but the 401k is with her present employer. Now what can she do with her 401k?
Well, then, the fact that she went from full-time to part-time, that may or may not give her the opportunity to roll the money out. That will really, what needs to happen is she's going to have to talk to the brokerage house who's administering the 401k plan with her company. And what she needs to figure out is the question of in-service transfers, meaning does the plan documents allow for her to do an in-service transfer where she can transfer her money from her current employer into some sort of a self-directed company so she can invest in alternative types of assets?
Yep, that's good. And so the real thing is if you do have a 401k or with your current employer, and you want to self-direct it, you really just have to talk to your plan administrator whether your existing plan administrator will let go of that money.
Yeah, and unfortunately, and we talk to clients all the time about asking that question. Unfortunately, most plan administrators either don't know what you're talking about, or they don't want you to take the money away from them, so they'll simply tell you, nope, you're not allowed to do that. So in order to get to the bottom of it, what you'll really want to do is you'll want to, make sure you corner them into the response, which is, does my plan documents allow me to do an in-service transfer? That way they can't, just kind of brush it off or lie to you and say, oh, no, it has to stay here. In terms of transferring money from your employer plan to your own self-directed account, it's not a limitation by the IRS at all. It's just whether or not the plan documents, some plan documents say, yeah, go ahead, you can transfer it, and others say, no, you can't. And so that's the question that you want to ask is, do the plan documents allow me to do an in-service transfer? And that's how you'll get the real answer.
there's an economic motivation for the current plan administrator to not let you do that. They don't want your money to leave. And so they're going to make it as hard as possible for you to do an in-service rollover. So you're right. You do have to be very, very persistent.
Yes.
Garrison asks, is the solo K the same as a SEP IRA? Is a solo K the same as an SEP IRA?
No, it is actually an entirely different vehicle. And again, the solo K, it's just one of many retirement vehicles. The SEP IRA, just like it sounds, it's actually just a type of IRA, individual retirement account. So some of the benefits we talked about, the Roth bucket, there is no Roth bucket to the SEP IRA. Also, we talked about being able to borrow and leverage and all that great stuff. That's also not available for the SEP IRA. But a lot of people who qualify for the SEP IRA also qualify for the solo K. So if you're someone who has a SEP right now, you're probably a really good candidate for eligibility in terms of setting up a solo K. So I definitely would have that further conversation either with us or with your current advisor to strategize on whether or not you could have the solo 401K instead.
A lot of people are asking, is the prohibited transaction rule the same for solo K as it is for self-directed IRA?
It is. It's exactly the same. I mean, a prohibited transaction is the same regardless of the plan. And basically prohibited transactions, again, are things like self-dealing, present benefit, providing services to your plan. Those are prohibited transactions, and they come into play regardless of the plan type.
Mm-hmm. Jim asks, can a married couple get $50,000 a year into their solo K each, or is it per person? Or is it per household?
Yeah, each. It's a great thing. And of course, when it comes to tax advice, I always defer to the CPA, so I'll let her elaborate on it. But it's great when I'll see a couple here with a self-directed IRA and a solo K, and there's one solo K plan, like an employer plan, with two employees in it, the husband and wife, and that's really a powerful tool. But I'll let Amanda discuss the specifics.
Yeah. I mean, no, Kaaren is exactly right. The contribution is based on each person. So if you have let's say we have an S corporation or a Schedule C, both husband and wife are working in it, we're both getting paid, or we both have, earned income from this business activity, then yes, each of us could contribute to our own solo K. Now remember, the solo K, we said earlier, it's an employer plan, which means, your business, right, that's the one business, we'll say John and Jane Company. That's the employer, and then we'll have two employees, John as one employee and Jane as one employee, and you can each make your own contribution.
So let's say that both husband and wife didn't really work in the business, but you wanted to take advantage of the $50,000 per person. How does the IRS look at that if, let's say, husband and wife are the only employees, but the husband or the wife does 99.9% of the work and the other spouse does 0.1% of the work, but they take an equal compensation? Is there any red flags there for the IRS?
Well, I mean, that is not so much of a retirement contribution issue. It really goes back to the reasonableness of the salary that you're paying each person. So if you're, if at the end of the day it's someone who's doing that, I mean, what you want to do is you want to support the reasonableness of the salary that's being paid to the wife in this example who's doing that thing. So maybe she's not, doing the day-to-day labor, but maybe she's really the brains behind the operation, or she's the creative side, and, that we can come up with some reasonable support for why she's getting paid, $10, $20, $50,000 of salary.
Mm-hmm.
So that would be the main thing that you want to have to support, which is, why is it reasonable that we're paying her the dollar amount that we are?
So you could pay both spouses $50,000 and then use that $50,000 towards their solo K to zero their income out to, potentially zero, right?
Yes and no. There's a very complex calculation when it comes to how much how much can be contributed. When we talk about $50,000 or $55,000 per person per year, that's the maximum contribution. There are different calculations in terms of how much can the employee contribute and how much can the employer contribute.
Mm-hmm. Great. And it gets so complicated, it really comes down to getting into a one-on-one counseling situation with your tax advisor. Tracy asks, is it advisable for him to pull contributions out of his Roth IRA to put into a solo K so that he can avoid UBIT in the purchase of leveraged real estate?
That brings up a really good point that I'm glad that we are addressing right now before we end, and that is you can never transfer Roth money into a solo K. If you have a regular Roth and your solo K has a Roth component, you cannot transfer or move the money from your regular Roth into the Roth bucket of a solo K. It just isn't allowed. I'm not sure exactly why, but that is the rule. That is the rule. So no, it doesn't make any sense to move it at all because it's actually disallowed.
Yeah, and that's such a great question because, you know, here's the thing is I feel like we're bringing a lot of educational content about the solo K and the benefits, and I'm also getting a lot of questions on people saying, I wanted to move my Roth IRA money into the solo K. And, you know, I agree with Kaaren that unfortunately that is one of the things that's specifically prohibited from the code for no good reason. Hopefully they'll change it in the future, but right now there's nothing we can do to, you know, to change that of whatever money is already in that Roth account.
Yeah, I can't think of any reasonable reason for it. I mean, there's no taxable event either way, so why not just let people do it? It doesn't affect the taxes, but who knows?
Yeah. We've gotten more questions on this webinar than any other webinar we have done, and that just to me shows how interested people are in this particular topic. Unfortunately, we're running up against, we're actually way over time for this particular webinar. I think people have an interest. There might be a webinar that we do again in the future, but we're going to head towards wrapping up. Can Amanda and Kaaren, can you just give a little bit of a 30-second commercial on what your companies do and how people might engage with you as a company or a provider?
Sure, I'd be happy to start that. Again, my name's Kaaren Hall, and the company is UDFI IRA Services. And what we do, we're a third-party administrator. We do the administrative work on helping you set up, open, fund, and invest a self-directed IRA. We don't give investment advice. We're not here to give you tax advice. That's what Amanda does. But what we're here to do is to provide this opportunity for you to take your retirement money and put it into what you know best. And that is exactly the thing that we do.
How people can engage with Keystone.
Yes, thank you so much, David. My name is Amanda Hahn, and I'm one of the managing directors of Keystone CPA, and we are a tax strategist firm. We specialize in working with real estate investors as well as small business owners. And you know, you probably can tell one of our specialty areas in working with small businesses and real estate investors is on all the creative strategies of retirement investing and self-directed investing. So, you know, I know everyone's situation is unique to you, and I know we probably have a lot of questions that we didn't have time to cover. And so if, you know, you wanted to get in touch with us, our phone number is 877-975-0975. And I do invite you to check out our website at www.keystonecpa.com. We have a really great free ebook. It's called 5 Cash Flow Strategies for Real Estate Investors. So you can simply visit our website and download a free copy of it. It's a fairly quick reading. It's not 1,000 pages of the code, so hopefully it won't put you to sleep.
Fantastic. And the best testimonial I can give to both Kaaren and Amanda is these are the service providers that I use, and they're both fantastic people to work with. My company is the piece that allows you or gives you a vehicle to invest with or in. So if you're looking for real estate investments, either individual real estate investments or group investments, we specialize in both residential and commercial property. We've got a great team on our website. There's a lot of free content, some ebooks, and really encourage all of you to reach out and get to know the faculty on today's call.